So my name's James Saw. I'm the Chief Investment Officer of SyndicateRoom. SyndicateRoom is an online investment platform where high net worth and sophisticated investors are able to invest in alongside predominantly private equity companies, but also listed. And primarily we look at businesses that are looking to raise capital of about 250,000 to about £3 million. We also have an investment fund for those that don't wish to pick the stock, as it were. And it's the first early stage investment fund that's structured in a passive way, which actually closes quite soon. So today I'm just going to give you a brief talk. We were told not to pitch our services too much, so I've actually probably taken that a bit too much to heart and actually going to be talking not very much about my platform at all, but more about the principles of investing, some stuff that I've learned and some things I've found interesting. And in general, talking about taking the contrarian view. Free lunches and other heuristics. So we're going to talk very briefly about some core principles that sit within grey and value investing, and some choice behaviours to be aware of, and then a free lunch. So value investing, so Benjamin Graham wrote a book called The Intelligent Investor. And the basics of value investing and the principles can be applied to both public and private market deals. And they give you a framework to begin thinking differently about the way that you're viewing and pricing and making investment decisions. He rose to prominence during a highly depressed phase of the market when he was able to pick up companies in, one might argue, a unique position that he actually rose to prominence in, but you were able to pick up a company that its intrinsic value, its value that you can actually liquidate the company for, was higher than its actual trading price, which doesn't particularly happen that often. And during this period, there was a number of companies in that situation. So he actually was able to build a set of principles that was centered on that type of investing approach. So one of the first sort of key principles is treat a share of stock as a proportionate ownership of the whole business. It might sound a completely obvious thing to say, but actually there was a whole market, there was a whole public market that set up actually looking at the price of something, not the value. And what that means is that people are looking at a share and trying to make an investment decision about whether they think that share is going to go up or down in value based on lots of different factors. A lot of the time they actually forget about taking the number of shares in issue, multiplying it by the share price at that time, and looking at the core business and saying, is that core business worth 1.6 billion or whatever the number comes back at? And running a set of mental models, as it's called by Charlie Munger, you build yourself a set of mental models that help you challenge the decisions that you're taking. And one of these ones is about making sure that every time you think about selecting an investment and a share of that company, treat it as if you're actually buying that company, a chunk of, and you tell yourself how much would that whole company be worth. So what would someone actually pay for that business? I can't stress how important it is to try and make that distinction about what the price that you're paying and actually the reality of the underlying value. So if you think about the difference between the two being the price is what you pay for a share and the value is what you get, that's quite a nice way to actually think about them being distinct. So one example of this sort of perverse inversion of perspective, I call it, is what's called the Kinsey and beauty contest. So it's a concept that was built, a hypothesis, an example that was built to try and explain this strange, irrational behaviour. So a newspaper takes out a contest and says that if you can pick the top 6 most beautiful people out of 100 people, you win a prize. Now the naive strategy would be to select what you think is the most beautiful 6 people. The second level is to, okay, well, what was the average person think is the most beautiful 6 people? And therefore, I'm best to pick that because that's more likely to be what the average result is. So I'm now not picking who I think is the most beautiful person or stock. I'm actually picking what I think other people are going to pick. And this example illustrates what a lot of people think about when they go into public markets. They make an investment based off what they think other people are going to do to that company. Do they think other people are going to like that company and therefore demand is going to increase and therefore that price is going to increase? Or do they think that other people don't like that company and that the demand is going to drop away and the price will drop? So you're not actually necessarily thinking about the business. The second level is thinking about when people look at ticker prices and look at momentums and all these different factors that you can put in to say that, okay, well, it climbed in the last few days or it behaved like this for a certain impact, certain result. It should do the same when this happens. You can trade in that way, but Benjamin Graham and Warren Buffett and Munger and all these other people, they forget all those types of things. They don't look at that element. What they look at is the intrinsic value of the business. So it means that the public market almost rewards investors who can select what other people will select, not actually what's the best underlying business. If you are going to buy into a business and you feel that you've made a valuation on its intrinsic value, you need to buy at a significant discount to its intrinsic value to create what's called a margin of safety. So the intrinsic value is what the company is worth if someone was to buy the whole business. When valuing shares, it's important that you relate it back to the total value of the business as a whole compared to its price. In engineering, so I'm a mechanical and electronics engineer by education, that margin of safety is something that people will be very aware of. If you're designing a bridge that you feel is going to be limited at 10-ton trucks or something, you design it so that 30-ton trucks can go over. You're not going to have a very, very short career as an engineer if you design stuff completely on spec, never giving yourself a margin of safety. And so when making investment decisions, you should also do the same. When you do your intrinsic valuation of a business and you come out at a certain share price, effectively back out, unless you're giving yourself a good margin of safety, so you can buy that share at a lot lower price than what you actually can value the business at, you're not giving yourself any margin of safety if that share price moves in a way that you haven't predicted. Warren Buffett refers to it as a moat, so it's his defensive moat. There's a defensive moat about the performance of the business, about whether it's got IP, whether it's got brand value, etc. And your margin of safety is one of those moats. It gives you an ability for you to get a position within a business and not be affected by micro trades and micro movements. Applying this sort of analogy about how far away you are from what you think the thing's worth to what you've paid for it, and giving yourself this margin of safety, can be used in driving. So I was always told, not to tailgate. The reason that tailgating is a dangerous way to drive a car is because your reaction times have to be so much quicker. And at some point, your reaction time is going to be slower than what the reaction time is needed to actually adjust for an idiot slamming their brakes on, and you smash into the back of them. There is a thought or a set of investors who very much drive tailgating. They're looking to get very, very close to what they think is a small margin of safety. And I would argue it's not very safe, but they're very much getting to a share price that moves by a few hundredths of a percent in a certain direction. They're highly leveraged, and they make sure that they try and make trades on those to make their profit in that way. I would equate that to driving within a paint thickness of my bumper to another car. You've got super high frequency trading and all these other things that are happening. I'm not saying it's wrong or anything, but that is a certain way of investing. And what I find interesting is about building yourself a margin of safety. And to that effect, make a bipolar Mr. Market your servant, not your slave. So if you agree or understand and believe what I'm saying in the other ones, where there is a difference between what the price is to what the intrinsic value is, if you're on a publicly traded market, you will have this Mr. Market. People talk about feeling what the market's going to do and all these types of things. But inherently, there is this combination of people who are making judgments through the Kinsey and beauty contest about what they think other people are going to do that day. So there's tons of different factors that are going on that are going to set this price that are away from, one would argue, what the actual business is doing. A perfect example I saw was when Apple's watch came out, and its sales figures were $50 million less than what the projection was. I can't remember the exact projection. I think maybe 600 or 500 million or something. And they were a number down, but I knew it was $50 million. Their share price moved by over $1 billion. Now, for me, that's a very strange reaction by a market. Why would you not knock £1 billion of value out of a business because it didn't meet its sales targets by 50 million? In that instance, Apple would have done better to have just bought their own stock, as it were, or even just thrown it out. And you know, it doesn't make any sense to me. So what I'm trying to explain is that there is this market that goes on. And if you believe or have the opinion that it's quite difficult to predict what that market's going to do, especially when you're driving so close to the tailgate, you know, knowing whether it's going to move up a small amount or drop a small amount is a very difficult thing to do. So Graham investors, value investors, look for not playing that game. If it's too difficult, put it in the too hard pile. Ignore it. You don't have to take that trade. And so if that thing is doing a very strange behavior, it's going to sell you something that at a price that you think is way below what it should be valued at. So then you exploit that. And other days it's going to want to buy something you own at a price that you think is way above what you think it's worth. So you exploit that. You don't make it your master, you make it your slave. So you let the market come to you about whatever the prices are, and you decide, do I want to take that transaction or not? You try and step away from judging about whether you think that market's going to go up or down, because you look at what the business is doing, which is generally on a bit more macro trade than on a daily pricing trade, daily pricing amount. So one example that I came across, well, it's two examples, but I sort of merged them together to my own sort of idea. So if you own shares in, say, Vodafone, and you want to sell those shares, you've got to find someone else who wants to buy those shares. There's an argument to be made that one of you has to be wrong. So whoever's selling the asset, the price that they're paying, it's going to go up or it's going to go down after that point. Therefore, if you sold at a certain price and it went up, you've done the wrong thing, one might argue, because you should have held on and run a bit more profit. If you're selling it and it goes down, then the person that bought it was the wrong side of the trade. So there's these two people either side of a trade. So if two people make a trade and the price moves somewhere, how many people win? Answers? Anyone? No? One people? Two people? You've got two people making a trade. How many people win? One. Wrong. One person loses on the trade. There's a person called a broker who sits between the two, makes a skim. There'll be a person that did a payment transaction. There'll be a person that did marketing, research, all these other... There's tons of different people in that transaction that are all set up to allow you to make a trade, and there are skims happening all that time. So even in a market where people talk about a zero-sum game, where it nets out, everyone makes or loses, and everyone trades between the two, actually what's happening is you've got a general reduction in capital because there's all these skims of fees that are happening. Every time you move something, the value drops somewhere. So if that's happening, then there is a set of investment principles that say you stay out of that position until you need to get in to make a trade. Don't feel obliged to trade. So be passionate. Be rational, objective, and dispassionate. Developing an investment mindset that's built on these principles is essential to a successful investment process and the likelihood of achieving positive results. So managing the way that you behave and the way that you assess things and taking out your emotions as much as possible, trying to make sure that you have an objective view about what this thing is. Try to cut out a lot of the noise. Try to cut out people who are incentivized to make you trade. Information that comes from certain people, there will be an incentive bias from them to give you certain bits of information. Researchers who are being paid by people that are trying to have their shares bought have a very difficult job trying to be completely fair and open because they're being paid by one person whose result they would like to hear a positive rather than a negative. So if you can start to think about the way that you approach the market as well, then, and these being rational, being objective, being dispassionate, you give yourself a better chance of not being caught up in some buzz that ends up making you do what happened in tech in 1999-2000. You know, there was a fear of missing out. Everybody was just investing because I would look stupid if I didn't go in and the thing doubled next year as well. And everyone knows what happened with that. Same thing with CDOs and all sorts of other stuff. But in general, your brain is split into two. There was a line of thinking that says that your brain is split into two types. You have system 1 and system 2. System 1 is sometimes referred to as fight or flight. It's your instant reaction stuff. It's the things that you just don't particularly think about. It just happens. The result comes to you. You see a problem, you see something happen, and the right thing to do or the solution just jumps into your head. System 2 is more about your thought. It's more about your using cognition, thinking about something, challenging yourself, being rational, etc. So I'm just going to do an example of a system 1, system 2 problem. And if I can ask that, or also, if anyone has any questions, feel free to answer, answer, because it saves my job. Ask throughout the presentation. But I'm going to show you a problem, and the moment that you think you've got that answer, if you can raise your hand. Apologies. Right, so bat and ball cost £1.10. The bat costs £1 more than the ball. How much does the ball cost? Go. How many people? Right, you got one there. A few more. A few more. Okay, so some people thinking. People don't know the answers. Still going. So I'm going to explain two things that are happening at the moment. Right, so those that did put their hand up, because a lot of you didn't, you're either lazy and have the answer and can't be bothered to raise your arm, or don't see it. But if you did raise your hand, did you see the answer just come to you? And it was 10 pence. No. Yes? No. So we have some yeses and we have some no's. The answer is no, it's 5. So your brain will jump to a conclusion. Total price, £1.10. Something is more by £1. Take £1 off. £1.10, 10 pence. Done. Solution. Your system 2 will challenge that. So using your brain, your thinking, rather than just your reactive thought, you challenge that hypothesis. Okay, well, if it was £1.10, it's 10 pence. So does that work? Is that £1 more? So 10 pence plus £1 more is £1.10. So the bat must have called £1.10. £1.10 plus 10 is £1.20, so it doesn't work. So you come to a result sometimes when your gut tells you something, but you need to think about using your system 2. If you combine that with some other, so now moving on to sort of behavioural economics and heuristics, if you apply now to some other behaviours that people experience, 2 seconds, loss aversion and the endowment effect. They're two different ways of explaining a similar problem that happens. There is a mug experiment where you get a group of people and you randomly give them, half of them mugs, half of them pens, and you ask them to either sell or make a trade. They didn't own the mugs, it doesn't matter what the mugs are, but the idea is that you've given them something that they haven't earned, it's just been given to them, and then they have no real idea about price, but they have some idea about what they think it's worth. When you tot up the amount that they would need to be paid to release that mug, and then when you rerun the experiment, you can run it multiple times, different things, doesn't matter what the two items are. They are generally want about twice the amount paid to them than they would pay to buy it in the other instance when they weren't given it. So you've given someone an asset that they didn't own. They've got no real emotional attachment to. It's a mug. Who cares about a mug? And when they've been given it and they own it, they suddenly get an attachment to it that means that they will actually want twice the amount of money than if they didn't own the mug and they were being asked to buy a mug from someone else. So the value of that asset doesn't change because it's a fixed price, but the willingness to pay and the willingness to accept changes quite a lot. That's what's called the endowment effect. It means when you own something, you're more inclined to hold on to it, and you want more than you would if you were trying to buy it. Loss aversion is a similar example of this type of situation, where people generally feel a loss about twice as painfully as they feel a gain. And that generally means that people then are very loss averse, so they don't like having losses. An example that I sometimes use is that if I came back into the office over a weekend and said, guys, I flew to Vegas, had a brilliant weekend, and I won $1,000, people would say, oh, that sounds great, you had fun, etc. If I told them exactly the same story, but I said I won $50,000 and then carried on gambling and lost $49,000, I'm a mug, I'm an idiot. Why did you lose $49,000? Well, the net effect is I end up with $1,000 profit out of doing whatever I did. But people feel when you lose money, even if you've given them and taken it away, like you do with the mug, you give it to them and take it away, they feel that a lot more than they do, they feel it about twice as much. So, and the other thing is confirmation bias. So if you're going through this investment decision-making process, and you're trying to challenge your thinking in all these ways, make sure you're not using system 1, make sure you're using system 2, make sure you're not suffering yourself from loss aversion. I don't actually want to sell this because I think it's worth more to me just because of that, not actually its intrinsic value. Am I valuing it based on what the market's telling me it's valued at, et cetera, et cetera. I think one of the last ones we're looking at is confirmation bias. So confirmation bias is a behavior whereby people tend to hold on to an idea they had, and when they seek to bash out the idea, so you might say to guys, look, I've had this idea, I've got this investment strategy, let's sit down in a room, we'll thrash it out, we'll sort it out, challenge it, etc. What you end up actually doing is what I call bashing it in. You end up finding evidence that tells you that that's the right thing to do. So when you're searching through information, you have an inherent laziness. There's lots of other tricks you can do on people to show what their laziness is about vision. When your eyes are lazy in the sense that if it thinks it's seeing the same thing again and again and again, it starts to ignore what's coming from your eyes and just tells yourself it's quicker just to tell him he's looking at the same thing. So when you stare at a black and white image of something and then suddenly take it away, your eye sees that image for another half a second or so. So your confirmation bias is scouting out information that goes, okay, yeah, that supports that thing. Oh, no, but that supports it as well. And what you need to try and do is to be rational, dispassionate, objective, and look at the real information and try and say, well, does that really support my hypothesis? Does that really challenge it? And when we come across information that's consistent with our beliefs, we usually accept it with ease. And our bias is to uncritically accept information unless there is an unavoidable reason to doubt it. Yet when we discover facts that force us to question our beliefs, we pass through a different filter that, must I believe this? You challenge yourself about something that tells you that the thing you've just seen means you probably shouldn't believe what you previously did. So you end up sort of constantly filtering all this information and ending up just reaffirming a position. And the net result is you walk away from there thinking, well done, guys and girls, that was a great session, really enjoyed it, I feel really confident about what I'm doing. Actually, all you've done in there is just sift through the world of information to try and tell you the things you want to feel so that you can go and make that investment decision. Dan Gilbert summarized it in an interesting way. When our bathroom scales deliver bad news, we hop off them and on again, just in case we misread the display or that we had like 1 foot in the wrong place, etc. When the scale delivers us good news, we smile and head straight for the shower. By uncritically accepting evidence when it pleases us and insisting on more when it doesn't, we subtly tip the scales in our favor. And I would argue I agree with all of that until to the bottom. Actually, I think we actually tip the scales against our favor because we're suffering from these behavioral, these heuristics, these system 1 behaviors where we just think that it should do a certain thing. And when we search for information, it reaffirms what we originally believed. So I called this free lunch. one reason a lot of people will go to lunch for a meeting. There's a very simple argument to say that why do you ever go to lunch for if you're having a proper business meeting, you should just go to a room and sit and look at cold hard facts. But that's dispassionate. That's not making an engagement with someone. And I perfectly agree that networking and so on and so forth is a good way, and I use lunch as a good way to have meetings. But you're giving someone something. There's a transaction there that subtly adds to your experience of what the decision is you're going to make out of that interaction. The other reason I called it free lunch was because for those investors who, and this is really the finest, tiniest skim of what can be learned in this space, I think Charlie Munger has nearly, I think it's 90 mental models of those types of things, confirmation bias and all these things that help him make a decision. But those types of behaviours and those types of things can help you make an investment decision. And for those that don't want to learn all of that type of stuff, there is or don't want to make all of their investments in that space, there is this free lunch of index-linked investments. And ETFs are a prime example. The rise of ETFs in the space has been phenomenal. And these allow you to gain access to a market without the cost base. So if you're going to do it actively into an active managed fund, there's an argument to say that for you to select which active fund to go in, you should be able to select investments as well as the active investor. If you can't do that, you can't assess which of the two active investors are the right ones. If you're going to use a platform, make sure the costs are as low as possible, that they're not incentivizing you to make trades, because somebody referred to investing. It should be a bit like a no strike game. So you don't have to swing at every ball that's thrown at you. In baseball, if you throw a ball and it's good and you don't swing at it, you lose. Investing should be very much like a no strike baseball. You should be able to stand there, and if you don't want to make an investment, don't make an investment. There should be nothing around you that incentivizes you to make an investment other than your own rational decision. And so make sure that the fee bases of all of these active things are as low as possible. And the tiniest little plug about what we do is that we looked at the market for passive funds, which we think are an interesting space to be. We are currently offer an active platform where people can make their own investment decisions. And so we actually built the first early stage passive fund. So we've invented a fund that will look at building out a diverse investment portfolio across at least 28 investments in early stage space. So that was our attempt at doing a passive product, which is called Fund 28. And I think it closes in like 4 days or something. So I'm now doing some of the things that I've told you to be careful of, time pressured and all sorts of things. But it's a very interesting space for me personally. I find it very interesting, and I don't know what I'm doing, in the sense that don't pretend that I'm telling you I know exactly what to do. All I'm telling you is that there are lots of people that have learned lots of things in this space, and the more that you equip yourself, the better chances are that the investment decisions that you make will generate green rather than red. Okay?